We kicked off the programme this morning with Steve talking about a little bit of the confusion in the markets at the moment. And I said, look, let's refocus on something that the markets will be able to take to the bank, and that's a June rate hike from the Fed. Is that going to be delivered?
We think it's going to come either in June or July. It's hard to call between the two, but we think that certainly this summer you'll get a rate rise from the Fed. And we expect another one as well by the end of the year. So our sort of core forecast is for 2 rate rises by the end of this year.
And is that why, at this point, markets are starting to slow down or run into turbulence? Because this speculation around the Fed move is generating caution.
I don't think so, really. I think actually the markets and indeed the US economy can withstand increases in interest rates. The US economy, after a first quarter, looks to be rebounding now. If you look, for example, at the new orders component of the ISM non-manufacturing survey, that bounced really very strongly in the latest reading. I think that gives some indication that that sort of weak first quarter that you saw was a bit of an aberration. We've seen several periods over the last few years where you've had a weak first quarter and then a rebound in the sort of rest of the year. And that's our forecast for the rest of this year as well.
And yet you remain, Matthew, underweight US equity at this point, I think. Is that based on the economics and a different view? Or is it just the corporate earnings are not delivering?
I mean, it's definitely the latter, and valuations, but also when I look at the top-down data, I look at non-residential capex, and I see that as looking like it's declining slightly, and that's often a very important lead indicator for unemployment. Of course, unemployment links into consumption. It's been consumption that's been driving the US economy. And with valuations so high, I guess I worry that you're caught both ways. If we see rate rises with valuations high, investors are going to worry about what that does for their dividend discount models. And if rates don't rise, it's because the US economy is not strong enough, or the global economy, but more like the US economy, is not strong enough to withstand those rate rises, in which case investors will sell equities. So to me, you're going to get caught both ways. It's a question of which one catches you.
I mean, we agree that you should be not expecting too much from US equities over the next 12 months. We think that the majority of the reason that earnings have fallen over the last year or so has been because of the dollar and because of the fall in energy earnings. So we think that with a rebound in the oil price, you should see a little bit of a rebound in energy earnings. At least even if they don't fall anymore, that will no longer detract from the earnings that you saw a significant hit from last year. And clearly the dollar weakening a little bit as well recently should provide some sort. So we think that you get earnings growth in the US, that's sort of low single digit, and that leads through to, again, a sort of low single digit return for the equity market. Because we don't think you get any expansion in valuations, but we don't think that there's any reason for them to contract either. It's interesting what you said about the residential capex, because I mean, if you look at earnings, they're traditionally a very good lead indicator of rollover in payrolls, for example, in the labour market as well. And we'd agree that if you see any sort of turn in the labour market in the US, that would be a significant sign for caution.